Welcome to this presentation on SIPs, Systematic Investment Plans. When investors invest their money, whatever might be the asset classes in which they invest, they look for 5 things. They are returns, capital appreciation, safety, liquidity, and tax benefits. Returns means the investor should get regular income over a period of time. Capital appreciation means the value of the asset in which money has been invested should appreciate over a period of time. Safety means the investment should be safe. Liquidity refers to the ability of the asset to be converted into cash at short notice. Tax benefits means obvious, the investor should get the advantages of minimum tax or no tax at all. There are very few asset classes which have all these 5 features. Good quality stocks have all these 5 features. Good quality stocks give good returns in the form of regular dividends. They can give very good capital appreciation over a period of time. They are safe. They can be sold and converted into cash at short notice. And they give a lot of tax advantages in the form of exemption of dividend from tax, exemption of long-term capital gains from tax, etc. Financial history tells us that stocks outperform all other asset classes in the long run. In India, stocks have outperformed all other asset classes, including the traditional assets like gold and fixed deposits, bank fixed deposits, by a wide margin. In 1979, Sensex was 100. Suppose a person invested 100 rupees in gold in 1979. By March 2015, it would have appreciated more than 19 times to touch 1,987 rupees. If a person had invested 100 rupees in bank fixed deposits in 1979, it would have multiplied more than 22 times to touch 2,225 rupees by March 2015. But if a person had invested 100 rupees in Sensex stocks in 1979, his investment would have multiplied more than 270 times by March 2015. As I speak today, in September 2016, Sensex is more than 28,000. This means the investor's investment has multiplied 280 times. This is incredible investment returns. Stock market history is replete with examples of phenomenal wealth creation. To participate in this wealth creation, investors should invest in equity. But only a small minority of investors have the time and expertise to invest in equity directly. For the vast majority of people, investors who do not have the expertise or the time to invest in equities directly, the ideal investment strategy should be to invest in equities indirectly through the mutual fund route. Mutual funds are financial tools that mobilize the savings of investors and invest this money in financial securities like stocks, bonds, etc., in accordance with the financial goals of the investor. Very broadly, mutual funds can be classified into equity mutual funds, debt funds, balanced funds, and liquid funds. Investors invest in liquid funds for meeting their short-term unexpected requirements to face unforeseen contingencies of life, and also for parking their excess money for the short period. Investment in equity funds, balance funds, and debt funds should be done in accordance with the risk appetite and financial goals of the investor. In India, mutual funds have done exceedingly well. We have seen in the previous slide that the stock market investment multiplied 280 times since 1979. This will work out to an average annual return of around 16% CAGR, compound annual growth rate, substantially higher than the returns from bank deposits and gold. But actually, mutual funds have done much better than the indices. Most mutual funds in India, equity mutual funds in India, have done better than the benchmark indices. There are many funds which have given more than 20% CAGR on systematic investment plans. Therefore, investors should be investing through mutual funds. Now the question is, how to invest through the mutual funds? What should be the method of investing in mutual funds? Lump sum investment in mutual funds can be a little bit risky. Therefore, the ideal strategy should be to invest regularly, periodically, systematically. Under systematic investment plans, money is invested regularly, usually every month, for a long period of time. There are two issues in investing in mutual funds. Two issues in mutual fund investments. One is price and the other is timing. As I said, lump sum investment at one point of time can be risky. There is a possibility that the investor may be caught investing at the market peak. For instance, if a person had invested at the peak of the market in 2008 January, he would have had to wait for many years to recoup his initial investment. Therefore, lump sum investment can be risky, but if we invest systematically, this problem of pricing is solved. The other issue is the issue of timing the market. Typically, investors invest when the market goes up. They reduce their investment when the market comes down. And if there's a major correction in the market, investors get fearful, sell and totally exit from the market. This is just the opposite of ideal investment strategy. Ideally, investors should be investing regularly, systematically, through the ups and downs of the market for the long term. The systematic investment will solve these two issues of pricing and timing on the market. Now, in the long run, investors get substantial benefits because of the power of compounding and the low average cost. When the investor invests regularly, when the market comes down, as it invariably will, the investor can buy more units at lower price. This will reduce the average cost in the long run. This is called rupee cost averaging. So lower cost in the long run and the power of compounding, which can work magic in the long run, will give the investors substantial, incredible capital appreciation. Therefore, it is desirable that the investor should start early to reap these benefits of power of compounding. Let me explain this with the help of a slide. Here we are taking two individuals, A and B. A starts at age 30, B starts at age 35. So A starts 5 years earlier. Both are investing 5,000 rupees every month. And both invest up to the age 60. Since A started at 30 and continues his investment up to 60, he or she invests for 30 years and the investment amount would be 18 lakhs. B started at 35, so investment up to means 25 years of investment, 5,000 rupees every month. He or she would have invested 15 lakhs during this 25-year period. But see the difference in the value at the time of redemption. 15 lakhs of investment by B would have given him or her a redemption value of 94 lakhs 88,175 rupees. Whereas 18 lakh investment, just 3 lakhs more investment by A would have given him or her 1 crore 76 lakhs 49,568 rupees. The difference in investment is only 3 lakhs, but the difference in the redemption value is more than around, let us say, 82 lakhs. This is the power of compounding. Also, power of compounding manifests through higher returns also. A small difference in the rate of return can work magic in the long run. For instance, 1,000 rupees invested per month for 30 years at a return of 6% would give a redemption value of 10 lakhs. When the return rises to 10%, the value of redemption will rise to 22 lakhs. And when the return is 15%, the redemption value will be a substantial 70 lakhs of rupees. And the most interesting point here is, in India, SIPs have given very consistently more than 15% over a long period of time. There are many funds which have given more than 20% compound annual growth rate during the last 20 years in India. Therefore, this is a very safe method, sure shot method in the long run of creating wealth. Coming to the tax aspects of investing in mutual funds, whether through the systematic investment plan route or through the lump sum route, the tax advantages are that the long-term capital gains are completely tax-free. That means the investor remains invested for 1 year and sells after 1 year. The gains are called long-term capital gains. These are completely exempt from tax. If the investor sells within 1 year, it is defined as short-term capital gains tax, and the tax applicable is 15%. The dividend from mutual funds, equity mutual funds, are completely tax-free. Also, if the investor is investing through the ELSS, Equity Linked Savings Scheme, then the investor can avail of 80C benefits under the Income Tax Act up to 1.5 lakhs a year. Coming to non-equity funds, long-term capital gains are taxed at 20% with indexation benefits. Short-term capital gains are taxed at 30%, and the dividend is subject to dividend distribution tax of 25%, plus of course there is surcharge and tax on top of this. Traditionally in India, investors have been investing, savers, households have been investing mainly in physical assets like gold and real estate. In India, 65% of household savings are invested in gold and real estate. Only 35% are invested in financial savings. Out of this 35% investment in financial savings, 65% are invested in bank deposits, provident fund, pension funds, etc. Insurance accounts for around 20%. Mutual funds and stocks account for less than 2%. In India now we have around, let us say, 15 million demat account and around 50 million mutual fund folios. In a country with a population of more than 1,200 million, 15 million demat account and 50 million mutual fund folios is abysmally low. What this means is households in India are not benefiting from the phenomenal wealth creation that is happening to the capital market route. Therefore, if investors are to gain from the capital appreciation, the returns, the wealth creation that is happening in the stock market, they should be investing in equities, preferably to the mutual fund route. In the mutual fund, preferably the method should be systematic investment plans. India took 60 years to touch a GDP of $1 trillion. 60 years since independence in 1947. So our GDP touched the 1 trillion mark in 2007. It doubled in the next 7 to 8 years. That happened in the year 2015 when the Indian GDP touched $2 trillion. Now there is a consensus that Indian GDP will double to $4 trillion by, let us say, 2022, 2023. And the market capitalization in India also, that is the value of the stock market, is also likely to touch $4 trillion in the next 8 to 9 years. That means we are going to witness incredible, unprecedented wealth creation in the Indian stock market in the years to come. Unprecedented value, wealth creation is going to happen. If investors are to benefit from this historic opportunity, they should be investing in equity, preferably through the mutual fund route, ideally through the SIP method. Invest in mutual funds to participate in this wealth creation, sip and create wealth. Thank you.